Hello and welcome back to the channel. Let's go on with part 43 of our international taxation introduction. And we are speaking at the moment about tax planning. So measures again taken by states against tax planning models are most important if you want to find out first how tax planning works and what still might work. So, last videos talked about CFC legislation, so that revenue which you make via companies abroad might indirectly be taxed in your hands. And this is now about the treatment of expenses which you make in order to lower your profit in the inland. The trick here is, or the thing which all these countermeasures here have in common, is that the business expenses are denied their deductibility. So you cannot use them to lower the taxable income, which means they will be ignored, partially or completely ignored, for the computation of your taxable income. Just to illustrate that. So imagine you have an inland company and here the tax level shall be 40%. We have a given revenue just invented of 10 million, and now we want to have an intra-group contract with a foreign related company. It's about a credit. So 4 million interest are paid. That brings along expense for the inland company and brings revenue for the foreign company. Now let's look to the tax consequences. If we now have a denial of deduction, then the revenue in the inland is still 10 million because the 4 million are not deductible. So they are treated as if they not exist. So you will have to pay, among others, on these 4 million still taxes as if you had earned that money. So 1.6 million will be paid on that amount here. And however, the other state will not bother about the non-deductibility. They will say it's interest income of my company. And so if their tax rate is 10%, they levy 10% on the 4 million interest revenue. So if you take it all together, then the taxes for the group have now increased and not decreased. The increase aspect is not what really is aimed at by the state of the inland company. What they want to intend is simply that making these expenses brings no profit or no advantage anymore for you in the tax profit and loss calculation of that country. Just by ignoring that, that can simply be achieved. Now, you probably thought that, well, we have spoken about CFC legislation about the whole last chapter, and the newer variants, which are wider. Probably you say, that already solved my problem. If I transferred money from an inland company to a foreign company, and if it's really lowly taxed, then it will again be indirectly taxed on the level of the shareholder. So no problem. And so you probably have thought that's already enough. Why do we also need cases where we deny the deductibility of business expenses? Well, let's have a look how it works and should work. If we just have an inland business and we pay interest, then that interest shows up in the foreign company as revenue from interest. And if we have a CFC legislation case, then it would also show up again on the shareholder level as an AFI from the CFC rules, 1 million. So indeed, we would have no tax advantage, at least not an actual high one, because what is not taxed on the level of the inland business will be taxed again in the inland of the level, on the level of the shareholder. However, the constellation is not always this way. It does not always work this way. Imagine again we have an inland business, we pay interest, it shows up as revenue on the level of the foreign company, and now the shareholder is unfortunately also in a foreign state. So a foreigner holds the shares or the property rights in the inland business. So we cannot subject that foreign shareholder to an AFI in the inland because we are not able to tax that shareholder. So in these cases, we still have problems where CFC legislation and all these related aspects do not really shield the financial interests of the inland. And so that's it. Furthermore, money can also be lost in case of an inland shareholder if the inland shareholder does not hold a sufficient high majority in or participation in the foreign company. You remember very often the CFC legislation is only triggered when somebody has 50 plus X% of the foreign company. Or it might be that the foreign company is low taxed at a lower level, however, not lowly enough to trigger CFC legislation under my home state's legislation. So that explains why states also want to have some additional tools to fight tax saving here. And as you remember, there were two basic effects. You could shift revenues to another state, then CFC legislation might say, okay, we bring it back in form of an AFI, or you could create expense, and in that case, the countermeasure would be just to say, let's ignore that expense for tax purposes. And so you see here, yes, that's also necessary if you really want to shield your tax base against being hollowed out completely. One of the oldest examples, which I know, for using that technique is the trade tax regime in Germany. There, the trade tax is levied by the cities and only on business income, and it would be very easy by doing contracts with private persons to shift a great amount of the money which a business produces to the private sector, where it can then not be subjected to trade tax anymore. And you know probably from other lectures, business taxation or so of mine, that the trade profit as a tax base for German city tax, trade tax, also in German called Gewerbesteuer, is computed in a way that a certain category or list of certain business expenses is just added back to the profit, so that deductibility under income tax is revoked for trade tax, partially at least. For example, interest payments, rent payments, license fees. It's nearly a list of everything which should also be of high interest for tax saving internationally, because the underlying problem is indeed the same. And yeah, so you can see that probably the technique to say, okay, if you want to shield our tax base against being lowered to zero or nearly to zero, then we need to deny the deductibility of certain business expenses. However, you must see, if you do not accept a business expense which somebody makes, then that business expense is worthless for tax saving. So these people will not do the expense anymore if they can avoid it. However, it might be that they can't avoid it. So we also must have a look on the cost effects of the non-deductibility. The first thing is, if a certain expense can't be deducted as business expense from the tax base, then, and you still need to pay out to your contract partner that amount, then you need to take that amount from your taxed net income, so your income after tax. So if you have to make a payment of, let's say, 100,000 for such an expense like an interest or so, then you first need to earn a gross income and pay taxes on it, which then leaves enough net income to pay these 100,000. That means if you want to calculate how much you then need before tax, if your tax rate is 40%, then your net income remaining would be 60% of the original number. So if you have to pay out 100,000, this must be the net amount. So this must be 60% of the unknown gross income. So If you divide the 100,000 by 60%, then you get the gross amount which you need. Here it would be 166,666. That means the non-deductibility increases the cost of an interest financing here by 166%, just because you have to earn 167,000 approximately in order to have after tax then a net amount of 100,000 which you can pay out. So non-deductibility can, naturally that depends on the tax rates, can increase the costs of certain expenses enormously. And you need to take that into account, because if such a business expense, if it serves for tax planning, then people won't do it because it becomes too expensive. But however, if they need to pay interest because they had to borrow some money from somewhere, then it increases greatly the costs. Furthermore, one of the things which you have to keep in mind is that the revenue which corresponds to the expense on the other side will nevertheless be taxable at the hands of the recipient, because the state of where the interest goes to will not bother about the non-deductibility. They will say somebody has interest income. How it was treated in the hands of the person who paid it does not really matter. So it causes additional tax expense in the hand of the recipient. And in the end, it might even be subjected to an AFI on the level of the shareholder if that foreign company which has the revenue is lowly taxed and is held by an Indian shareholder. That case would probably be the maximum catastrophe for a tax planning idea, because that would have gone wrong completely. To illustrate that, imagine you have a shareholder, inland business, foreign sister company. Here is the interest payment. Here is the interest revenue, but it leads to an AFI in the hands of the shareholder. The inland interest is not deductible. Let's imagine this. So here we will have to pay full taxes on the 1 million which we have. Then we have foreign taxes on the 1 million, and we have, last but not least, also the CFC taxes on the 1 million. That means, as you see from this example, things can go horribly wrong if you do tax planning without proper knowledge of all the consequences in all countries for all people involved. And that shows that nowadays tax planning should not only be about finding loopholes where you can achieve tax advantages, but you should also be aware of the traps of the system where looking for loopholes can go horribly wrong, or where even a normal behavior could end up in a financial catastrophe. So that's more and more important nowadays. Shield your people against double taxation or unfair or inadequate taxation, that too much tax arises in a cross-border situation. Now, if we know why business deduction limitations can be found, we should just say where they are often found. The most frequent examples are interest payments or license payments. For example, there is a famous institution in German law and in the law of several other states which is called an interest barrier. You can deduct interest only up to a certain limit, and everything which is more than this percentage of the money which you earned, if you pay more than that as interest, the rest will be not deductible. Very often you have structures of these limitations in a way that because the cost consequences of a business expense non-deductibility are so drastic, that then a state says, okay, we tolerate a certain extent of these expenses as normal, so that business as usual can happen and you can deduct it. However, if you have enormously much of them, so that you are overdoing, let's say, interest financing or overdoing payments for license fees, then we react and trigger a non-deductibility, either for the whole amount or for the exceeding amount. That's a matter of what the state then wants to achieve. Um, and but there, this basic phenomenon that usually you have a certain amount which can be deducted and only later problems begin, that will be very, very frequent. Naturally, where a state sets the limit, up to that limit I'm going to tolerate payments, beyond that limit not. That's entirely arbitrary. So you will have different limits in different states, and only the basic idea can be suspected to exist everywhere. So when you hear that the state has an interest barrier, you will have to look up the details there, naturally. You cannot assume that everything is always the same. Okay, that should be sufficient for today as a small remark on measures against tax planning. And yeah, recover well from this video. Come back if you like it. If you didn't like it, ask others to view the next video and have some fun if they really do it. Yeah, so I just can say goodbye and hope to see you soon again on this channel.